It's not a bad opening, to be fair. It's down but not out.
If you take from policy day, it is about a 20 basis point fall.
Softish day, so to say, snapping the rally that we've been seeing in the last couple of trading sessions.
Watch on the Nifty and the Bank Nifty. For the Nifty, 17,900 is that level, which should not be violated on the way down. We'll end 60 points lower, a quiet close, not down by any large degree. So, you know, it's a small one, 1/3% lower on the Nifty.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Reema Tendulkar, and these are the headlines for the day. The Sensex and the Nifty snap a 6-day winning streak to end with marginal losses. The Midcap index bucks the trend to end in the green. Bond yields cool to their lowest level in 13 months, boosting the borrowing prospects of corporate India. Hundreds of Go First passengers stranded as the cash-strapped airline suspends operations for 2 days. CEO Kaushik Khona says voluntary bankruptcy filing is aimed at protecting assets and finding a resolution. Adds that Pratt & Whitney paid compensation worth only $49 million as against claims of $950 million. That's an exclusive. Tata Steel reports a stronger than expected revenue and margin performance. Bears dead by nearly 4,000 crore rupees in the quarter, but concerns over softening steel prices keeps the stock in check. MRF surges over 5% on higher net profits and revenues on a yearly basis. Havells rallies 1% in the fourth quarter. Godrej Properties sees a sales volume jump of 19% versus last quarter. The stock closes flat. Crude prices plunged their lowest level in more than 2 months. Fears over rate hikes and demand drives prices lower. And here's a lineup of what we have for you in store today. In Market Opinion, we've got Ajay Srivastava, CEO, Dimensions Corp Financial Services. In Big Corporate Voices, we've got Kaushik Khona, CEO, Go First Airlines, and TV Narendran, MD and CEO of Tata Steel. But this is the big story, so let's address it. The big event that the investors world over will be watching with bated breath. The Federal Reserve monetary policy. They're all geared up to announce their rate decision tonight. A CNBC Fed survey shows 100% of the market participants are expecting a rate hike. But only 59% say the Fed should be hiking rates given the banking crisis in the US. A majority expect this to be the last rate hike in this cycle, with 77% expecting the Fed to hold rates in June. Here are some economists and market investors talking about their expectations from the US Fed.
The big picture problem is inflation. And if we just respond to market movements, we're just going to be pushed around and we're not going to solve the problem because they're going to go back to what happened in the late 70s, early 80s when the Fed paused too soon. Ultimately, 25 basis points one way or another is not going to make or break the U.S. economy.
Fed is going to avoid the stop-and-go monetary policy of the 1970s when, they had to hike on 3 different occasions to really kill the back of inflation finally in the 80s. And I do think that positioning is also centered around a hike this time of 25 basis points.
And stay tuned to CNBC-TV18. Our Fed coverage starts at 11 p.m. We will bring you all the action live from Washington to Wall Street. Now let's get to the domestic market action for the day. The Dalal Street fell on weak global cues ahead of the U.S. Fed rate decision. The Nifty and the Sensex snapped a 6-day winning streak to end 0.25% lower. Broader markets outperformed the blue chips, with the Midcap index ending in the green with a gain of about 0.25%. Prashant is here with the details. Prashant.
Well, the market ended lower today. The Nifty was down about 1/3%. The Bank Nifty was flatter still, losing even lesser. And this was a vast improvement compared to how things looked in the morning when the global handoff from Wall Street was negative. The cuts right at the open were deeper, but the market improved through the course of the day. So sectorally, what did well, what did poorly? Metals and IT were each down 1%, so pockets of losses. The only index which was up as a whole was FMCG, and the stocks will come up on your screen in just a bit. Losses first, though, because the market was as a whole was down. Nifty losers in the form of Adani Enterprises, Adani Ports, ONGC. HUL, Asian Paints, and ITC were some of the stocks from the FMCG pack, which are part of the Nifty, which did well. Public sector stocks have been flying, and that continued today as well. So take a look at RVNL, for example, a stock we've spoken about over the last couple of days. It's up. It's doubled in the last 20 days, basically 10% yesterday, 10% today again. IRFC, BHEL, Engineers India, Bharat Dynamics, SJV, and even, a long forgotten name like IFCI was up 10% today. MRF reported numbers which beat EBITDA by a very large degree, some 30%. CET and JK Tyre also participated on the back of the beat from MRF. The airline story in the form of what Go Air is doing is playing out. Indigo was a beneficiary. Bombay Burma, on the other hand, which is one of the holding companies of the Go Air airline, was sharply down. Otherwise, broader markets, lots of stuff which went down. Manappuram, there were ED searches which were going on. Adani Wilmar was down. Adani Total was down. Central Bank, UCO Bank, and a bunch of other public sector banks were lower as well. It's a day which kind of is going into the FOMC meeting in an undecided kind of fashion. The consensus is expecting a 25 basis point hike by the Fed later tonight. And I think depending on that and depending on what the Fed chair says in terms of his guidance, we will set the course and set the direction for markets tomorrow morning.
Prashant, thank you very much for that. In market opinion, Ajay Srivastava of Dimensions Corp Financial Services says the Indian market is driven by fundamentals rather than flaws.
Indian market is less driven by fundamentals, more driven by flaws. And we have seen the same thing happening. Once the selling of FIs stopped, it was a natural course of the market to start edging up, and FIs have bought some stock in that. And therefore, the market has taken up a little bit of wings, so to say, to come back to where it was.
Okay, moving on to the Indian macros. Indian bond yields have seen a sharp fall this week, with yields now at fresh 13-week lows. In fact, yields have been falling since the monetary policy on 8th of April, but this week we saw an accelerated fall in the bond yields. Lata is here to analyze the reasons.
Actually, it's a stealth rally. And although this week it is 8 basis points fall over the last 2 days, if you take from policy day, it is about a 20 basis point fall. And if you take from March 1st, then it is a 40 basis point fall, which means, corporates can actually borrow at half a percentage point less if you are borrowing from the bond market. This is the lowest the yield has been since April 8th of last year. So it's a 13-month low that bond yields are at. That's huge. Now, what is explaining this fall? Of course, there are the immediate reasons. US yields have been falling. Where are they? 3.5% in the past month or so. Expectation that both the RBI and the Fed are mostly done with rate hikes, and the expectations of US recession slowdown, if not recession, is pushing down crude prices. And, at 75, that will mean it will eventually at some point get passed on. But the bigger reason is the number of buyers have increased. The big buyers have been the HDFC twins, HDFC Bank and HDFC. Obviously, they have to come with SLR at 22% for the combined balance sheet on the day of the merger, which is whatever, June or July or whenever it is. So there's huge buying by these two guys, which is, 18% of the new balance sheet. HDFC balance sheet is a large amount of money. The other big buyers have been insurance companies. Remember, the budget said that over 5 lakh premium will not get tax benefits. So a lot of the high net worth individuals bought those expensive, high-paying policies. And that led to a lot of money which, get invested in the form of FRAs, forward rate agreements. Because these insurance companies want to invest this money over time in bonds, because it's an insurance policy, they enter into these forward rate agreements with banks. So banks typically warehouse these bonds for insurance companies for subsequent years as well. That's a huge amount of buying that came in. So all this led to this near 0.5% fall in yields.
Lata, thank you very much for that. Let's get to the second headline now. Cash-strapped airline Go First voluntarily filed for bankruptcy before the company law tribunal late last night. Hundreds of passengers are stranded across the country as the carrier has temporarily suspended flight operations till Thursday due to lack of funds. The NCLT has agreed to hear the case seeking protection under Section 10 of the IBC tomorrow. Rival companies like Interglobe Aviation gained 4.5% in trade. SpiceJet too was higher. And to watch the entire conversation, tune in to CNBC TV18 at 5:30 and 9:30 p.m. Let's now go across to Sonia. She's here to tell us what Go First filing for bankruptcy means for competitors like Interglobe Aviation, and how will the aviation space be affected?
So the Indigo stock was up in trade after Go Air filed for insolvency with the NCLT, and the big question we're asking is, now with Go Air's bankruptcy situation, will there be a duopolistic structure in the aviation industry? Now there are a lot of positives for Indigo, of course. Go First insolvency will remove 9% of the domestic supply in the aviation sector. Go First moving away from the skies would mean more market share for Indigo. It would mean stronger yields. The aviation industry is doing pretty well too, and a lot of the lessors could perhaps move their, their fleet from Go Air now to Indigo, which will be a positive for them. But now what happens is there could be a duopoly situation in the aviation industry. There are just two large players. Indigo has a market share of over 57%. The Tata Group, which includes AirAsia, Air India and Vistara, have a market share now of around 30-odd%, which means 90% of the market is held by just two players. And a duopolistic structure is beneficial in the sense it's a structural up move that Indigo can see over the next couple of years, with higher yields, more market share and perhaps some pricing power as well.
Thank you very much for that. Post the development, many stocks connected to Go First stumbled on Dalal Street. Central Bank of India shares slipped nearly 5%. Bank of Baroda was down 2%. These are the two key lenders to Go First. Bombay Burma, that has a 32.5% stake in Go First, also slumped nearly 6%. Abhishek is here with the details.
Well, Go Air has been in focus, and there are various lenders to this company. So we have Bombay Burma, who has an exposure of around 318 crore in terms of the debt that they have given to Go Airlines, and they also have more than 32% stake in the company. We also have lenders who have given loans to Go Airlines. So Central Bank of India has an exposure of about 1,562 crores. We also have Bank of Baroda, who has an exposure of about 1,430 crores. Earlier today, Axis Bank had given a press release wherein they mentioned that they have no exposure at all to Go Airlines, whether it is on funded side or non-funded side. So you also have IDBI Bank, which has an exposure of a little under 60 crores, and Deutsche Bank has an exposure of about 1,320 crores. This is as per the report in Adequate Ratings way back in Jan 2023. Back to you.
Thank you very much for that. The third headline for the day. Titan has reported its Q4 numbers. Revenue is higher than street estimates, but the company has missed the mark on margins. They've also recommended a dividend of 10 rupees per share. Mangalam is here with the key highlights. Mangalam, we already have the cheat sheet. So how do the numbers compare with expectations?
Well, as far as the cheat sheet is concerned, that was on the company's revenue performance and margins as well. So if you just take a look at the revenues, optically they are higher than street expectations, but that's because the company has sold gold ingots worth 1,000 crores, 1,055 crores. This compares with 375 crores same time last year. What this basically means is that at the end of the quarter, the company sells the excess gold that it has, and that's a quarterly phenomenon. So that's the one that has caused a divergence on the top line. Adjusted for that, these numbers are largely in line on the top line, as well as jewelry margins as well at 13.2%, higher than the same time last year by about 70 to 80 basis points. So that was in line. What's not in line, however, are the eyewear margins. The eyewear business reported an operating profit of just around 2 crores. This compares to the loss of 8 crores. But at the same time, the street was working with margins of much higher than 10 to 15% in this space, largely because this was a business that was doing well for the company. And here, the miss on the margin the company has explained is because of a one-time 8 crore payment that they've made to eyewear franchisors as a recognition. You adjust for that, then the margins out there are around 6%, which is still lower than street expectations of double digits out there. So mild miss in the eyewear business margins, but rest all pretty strong. As far as the other details are concerned, the jewelry business, it's led by 8% rise in average ticket sizes and 15% increase in the buyers of the jewelry vertical. So all these factors really well. The only thing now one is awaiting is the management commentary on how the first quarter has panned out, especially with regards to sales in Akshaya Tritiya at a time when gold prices are higher.
Thank you very much for that, Mangalam. Let's slip into a break on that note, but stay tuned. We'll be back in a jiffy with the other headlines.
I'm a chameleon. It's my job to change color. But your wealth manager? Well, they shouldn't be copying me, you know? You know that. Choose Nuvama. We only do what's right for you and your money. Nuvama. Let's do it right.
Hey, buddy. Hope you like them.
Introducing Apollo Alpha. Add more thrill to your beast.
Z-Black Premium Agarbatti and Dhoop, official prayer partner, Delhi Capitals.
SMEs are a major force behind inclusive growth in New India. Therefore, it is essential to unlock the untapped potential of Indian SMEs so that they can create a future-ready international business with appropriate financing and technological solutions. Join industry stalwarts as they come together to mentor the Indian SME community at HSBC India SME Summit in association with CNBC-TV18.com on the 4th of May at 5:30 p.m. in New Delhi.
Balcony?
Same है.
Drawing room?
भी same है.
Kitchen area?
Same है.
हमने लिए 90 लाख में, आपने लिए 80 लाख में.
ये सेम क्यों नहीं?
क्योंकि आपके और हमारे होम सर्च ऐप सेम नहीं है. जानिए प्राइस ट्रेंड्स और सही ट्रांजैक्शन प्राइसेस on 99acres.com. घर लेना हो या बेचना, 99 acres से ही पूछना.
When our big boss was MD, he used to take care of us.
And our Prince Sahab is busy ensuring his family.
Oh, big boss, you?
He's busy obtaining term insurance for his family. After all, office is also our family. Am I right?
Let's close the deal.
Thank you.
Verma ji, will you have tea with this prince?
LIC's Group Term Assurance Plan takes care of your office family.
Welcome back. This is the fourth headline for the day. Tata Steel was under pressure despite reporting an all-round beat in Q4. The steel major reported a net profit of over 1,500 crore rupees versus an expectation of just over 800 crore rupees. Nigel joins in with the key highlights. Nigel?
Well, Tata Steel's numbers actually were a good set. Good operational performance, there was debt reduction, and they also gave out a dividend. Let's run you through the numbers first. In comparison to our polls, it was a beat on the top, the EBITDA number, as well as on the profitability. But as we know for Tata Steel, the geographical breakup is very, very important. And the India business delivered an EBITDA per ton in excess of around 16,500 rupees per ton, which is much better than around the 13,500 that we were estimating. The focus on costs and lower costs, that's the key reason that, gave this big beat on the India performance. On the European business as well, we were working with an EBITDA loss of close to around $107 per ton. It came in at a negative $94 per ton, so the losses were less than estimates. So hence, from both the big two geographies, you had a beat. On the Thailand business, well, it's a small part of their business, but there as well, you saw some bit of an improvement on the EBITDA per ton. The pleasant surprise came in on the debt number because the net debt reduced by around 3,800 crores, which is heartening to see. And also we had a dividend that was announced. But the question is, what's the way ahead from here on? How will prices as well as coking coal costs shape up? Well, I got chatting with the management. Mr. Narendran answered some of those questions. So let's hear him out.
So I'm not remembering the exact numbers of coal consumption cost, but this quarter will be about $10 higher than last quarter, consumption-wise. So the procurement may be about $25 to $30 lower in this quarter, but we will get the benefit of that only in the next quarter. So that's why this quarter margins will still see higher coal prices than the spot coal prices because we are getting what we bought 3 months back. And coal prices started dropping more in the last 30 days. With the existing sites, we have enough runway to expand to 40 million tons. So we don't really need a new site to go to 40, 45 million tons. No, we haven't. For NMDC, we haven't. Nilachal was different because we've always said that we were interested in long product asset. And Nilachal was a long product asset. It had 2,500 acres of land next to our existing site. It had 150 million tons of iron ore. So we didn't value it as a 1 million ton steel plant. We valued it for its entirety.
Okay, let's take a look now at the other earnings for the day. MRF surged close to 7%, beating street estimates for the fourth quarter. The company has seen a jump in profits and revenues, and plus the board has approved a final dividend of 169 rupees per share. Sonia is here with the highlights.
Well, thanks a lot for that. So it's a complete margin game here because of lower commodity prices and better operating leverage. MRF's margins are fabulous in this quarter. In fact, much above what the street was estimating as well. It's a 450 basis points year-on-year jump up in margins at 14.5%. It's a multi-year high that MRF has seen. On the top line, it's not too bad. Just a 10% growth is what they've seen. But a pickup in demand is what we've noticed across the board, along with lower commodity prices, is something that has aided their overall numbers. The profits have more than doubled this time around. Now, it's important to keep an eye out on stocks like Apollo Tyres as well. Apollo Tyres, in fact, is at a 52-week high. It will come out with its numbers over the next couple of days. And in that context, after MRF's strong showing, all eyes will be on Apollo Tyres. But for Apollo particularly, there's also the Vredestein business, which is in Europe. And Europe has been struggling a bit. So in that context, it may not, tie in with MRF's numbers entirely. But after the good showing from MRF, all eyes will be on Apollo now.
Absolutely, Sonia. Thank you very much for that. Godrej Properties rallied about 0.5% on the back of a good Q4. The company has reported a 58% jump in its profits year-on-year. Sonal is here with the details. Sonal.
Highest ever sales value and highest ever sales volumes. That's the kind of data Godrej Properties reported. We knew the operational update before the quarterly numbers itself. Just running you through them yet again. Sales value was up 25% on a YOY basis. Sales volumes up 25% on a YOY basis. FY23 sales bookings at 12,232 crore rupees is 22% higher than the guidance that they'd given earlier of 10,000 crore rupees. So it is, of course, a beat on all parameters. The net profit for quarter 4 also was up 58% on a YOY basis to come in at 412 crore rupees. Now they've given a guidance for FY24 as well, where they're expecting bookings of 14,000 crore rupees, cash collections at 10,000 crore rupees, deliveries at 12.5 million square feet, and business development at 15,000 crore rupees, which was over 30,000 crore rupees in FY23 itself. They added around 18 projects in FY23, out of which 5 projects were added in quarter 4 itself, with a sellable area of 9 million square feet and an estimated booking value of 5,750 crore rupees. This is in the quarter gone by. Their net debt has risen. That is because of higher capex that the company has been doing. On a quarter-on-quarter basis, it's higher by around 1,100 crore rupees to come in at 3,649 crore rupees. But yes, the operational data is strong, and so is the guidance going forward as well.
Okay, thank you very much for that. Yet the stock closed absolutely flat in trade. Let's move on and talk about Havells that rallied close to about 1% after reporting an all-round beat in Q4. Revenues came in at 4,800 crore rupees, a growth of nearly 10% higher than expectations of an 8% growth. EBITDA margins at 10.8%. Surbhi's here with the fine print.
Thanks so much for that. So Havells have reported a good set of numbers. The numbers are slightly better than the CNBC-TV18 poll. The revenue is up by 9.8% versus the CNBC-TV18 poll of 8%. The EBITDA is higher by 1.4%. There is slight compression in the margin. Margins have come in at 10.8% versus 11.8% at the same time last year. And the net profit is largely in line with the poll, came in at 358 crores. Now, most of the revenue growth is driven by the switchgear segment and the Lloyd segment. In the switchgear segment, the revenue is up 27%, and in the Lloyd segment, the revenue is up 32% on a year-on-year basis, and they have managed to maintain the losses at close to 23 crores. Now, what we have to watch out over here is the market share gain that they have gained in Lloyd, and also any commentary on the demand environment and the pricing pressures considering the unseasonal rain. The only negative in the Havells results is the electrical segment, where the revenue is down 14% and the margins have come in at 15.4% versus 19.7%. There was some weakness expected in the electrical segment due to the change in the BE norms, but I think 14% was not expected. But overall, a good set of numbers by Havells.
Thank you for that. And here is the fifth headline for the day. Crude prices have plunged to their lowest level in 2 months as fears over rate hikes and lower demand drove the prices lower. Manisha is here with a wrap. Manisha.
Well, yes, the crude oil prices have seen extended decline. We're trading at a 5-week lows. Yesterday was a 5% of a cut, and today as well, 2.5% of a decline. Over and above that is how the crude prices are trading. The markets did see a percentage point of gain in April, and this is after 5 months of constant decline. So clearly the month of May hasn't started any better for the crude oil prices. The U.S. politicians right now discussing ways to avoid the debt default. The deadline for that is 1st of June, is weighing on to the sentiment into the market. In any case, the U.S. jobs data has seen a decline for the month of March. We've seen manufacturing, services, factory activity, all of these numbers come in on the weaker side in US, in China too, and that's weighing on. China, of course, markets were keeping an eye on that. That would come back after those COVID relaxations, and you will see demand coming back, but that at best has been fragile, even uneven there. And then the street is watching out for Iran, which has increased production to nearly 3 million barrels per day. This is much higher than 2.1 million barrels per day they were doing in 2021. So we're looking at higher supplies, concerns about demand slowdown, and weak economic data. China not exactly back in what the street was anticipating, all weighing onto the street there. Add to that the fact that the US Fed rate hike expectations also are weighing onto the market. We've seen the dollar index continue to gain up. Not just US Fed, the European Central Bank meeting on Thursday also might be looking at increasing interest rates, and that's weighing onto the space as well. While most analysts will tell you that perhaps $80 a barrel is a fair price for the crude oil prices, but with the kind of decline that we are seeing right now, another $2 to $4 of a decline with the current momentum is quite possible.
Thank you for that, Manisha. With that, it's a wrap on this edition of Markets Today. Thank you for watching.